students. Already we discussed regarding capital budgeting techniques. In that capital budgeting techniques, we segregated into non-discounting methods and discounting methods. Previously, we discussed regarding the payback period belongs to non-discounting techniques. What is meant by non-discounting techniques? Already we discussed about that. Once again we will discuss. Non-discounting techniques ignores the time value of money. There is no consideration of time value of money has to be taken by the non-discounting methods. In that we discussed payback period, and another method is average rate of return or accounting rate of return. We discussed payback period early video. In this payback period, we discussed even cash flows, uneven cash flows. Now we will have a problem or information regarding non-discounting methods. ARR, average rate of return or accounting rate of return. What is meant by average rate of return and accounting rate of return? Means accounting rate of return is the average net income an asset is expected to generate dividend by its average capital cost expressed as an annual percentage. The ARR is a formula used to make capital budgeting decisions. They typically includes situations where companies are deciding on whether or not to proceed with a specific investment, like projects or into the acquisitions, based on the future net earnings expected compared the capital cost. Once again we will discuss regarding ARR. ARR also is the method of taking the decision on investment on projects or acquiring of the machinery based upon the future net earnings by comparing with the expected. It is nothing but the average rate of return. It has to be taken into the percentage. What is the formula for ARR? ARR equaled average annual profit by average investment, where what is meant by average annual profit means the total profit over investment period by number of years we calculate, means we will get the average annual profit. Then average investment by calculation of initial investment plus salvage value with adding of these two values and dividing with 2, we will get the average investment. Here we have a rules, acceptance and rejected rules will be there for in the ARR. If ARR greater than target rate, the project can be accepted. If ARR less than the target rate, the project can be rejected. If ARR equal to the target rate, further analysis is required. We have to do another way of analysis. For example, if we get an ARR 20%, the company required target rate will be 30, the project is rejected. Y means ARR getting less than the target rate what the company requires. In the same way, we have to calculate and do the decision regarding the acceptance and reject. Target rate is the minimum rate of return targeted by management. ARR is otherwise called as return on capital employed method. Its meaning the required rate of company gets more than or less than the decision has to be taken by the company with the help of ARR. And we will have an example. With that example, we will know how the project can be accepted and rejected. Here we have an example. Problem has given us Discover Limited is considering a project with a required investment of 6 lakhs. The details are given below. Expected useful life of machine is 6 years. Here they are taking the depreciation as a straight line method. With a salvage value of 1,50,000. The cost of capital is 13%, while the tax rate is 28%. Expected net profits are given below. Here the expected net profits in rupees they given for the 6 periods, 6 years. Here they are given as for first year, second year, third year and fourth year, fifth year and sixth year. For first year net profit will be 60,000, for second year 90,000, third year 1,10,000, fourth year 1,50,000. For fifth year 1,10,000 and in the sixth year it is getting the net profit will be 90,000. Through this problem we have to be find out the ARR and we have to make a decision whether they have to invest or not. Here the data given as the required investment of project will be 6 lakhs rupees and life of the mission will be 6 years. They are considering the straight line method of depreciation and the salvage value also they given 1,50,000 rupees and the required rate of company required rate of cost of capital will be 13. We have to compare with this. If ARR more than this means we can accept, otherwise we can reject the project. Next we will have a solution here. The solution will be, what is the formula for calculation of ARR? ARR equal to average annual profit by average investment. So we have to calculate the average annual profit, then we have to find out the average investment. What is the formula for the average annual profit? Average annual profit equal to total profit over investment period by number of years. What are the total profits over investment period? Here they given us, what are they? In the problem itself they given us for the 6 years they given a net profits 60,000, 90,000, 1,10,000, 1,50,000, 1,10,000 and 90,000. That we have to be added for the total profit over the investment period. Investment period will be 6 years. For this 6 years period, what are the profits we are getting, that we have to add over years. By adding all these net profits, we are getting 6,10,000 rupees, 6,10,000 rupees, and therefore we will find out the total profit, average annual profit. average annual profit equal total profit over the investment period. How much we get? 6,10,000. And what are the number of years? 6 years. Here we are doing that by dividing the 6,10,000 by 6 years. 1,1667 rupees we are getting over here. And then we have to find out the average investment. Average investment, for finding of average investment, we have a formula: initial investment plus salvage value. If they are giving the salvage value, means we have to add with the initial investment, otherwise they won't give, means we have to be specify over here only the initial investment. Here the salvage value they given us, means we have to total with the initial investment. What is the initial investment? 6 lakhs rupees plus salvage value 1,50,000 rupees by 2, we are getting the average investment 3,75,000 rupees. Then we will find out the ARR by dividing the average annual profit by average investment. Average annual profit will be 1,01,667 and average investment will be 3,75,000, and here we are doing with the percentage, that's why into 100 we are getting the 27.11%. We got ARR value and what is the required rate of return for the company? 13%. So we will accept the proposal because ARR is 27.11 more than the target rate, that is 13%. So we will accept the project. In the same way, we have to be calculate the ARR method. Here we have some advantages and disadvantages for the ARR method in the discounted cash flow, non-discounted cash flow method. What are the advantages are having by the ARR? Means it is easy to calculate and easy to understand, and it takes account of profit earned over the entire life of the project. Popular with some business because of its simplicity. It is very simple and easy to calculate, and here what are the companies generated by their profits, according that only they are calculating. These are the advantages. And what are the disadvantages? Here we have some disadvantages. Failure to consider the time of cash flows because it use a average. When we are not considering the timings of cash flows, those are not giving an accurate value. Why? Means the value of money will depreciated. When it depreciated, it cannot be give an accurate value present. And another disadvantage, takes no consideration of the time value of money or interest. That is only we are discussed now. These are the advantages and disadvantages of the ARR method. Thank you.